Okay, restaurant owners, April 15th is weeks away, and I want to talk to you about the consequences of filing your tax return late or walking into a deadline unprepared. I have worked with business owners for over 20 years, and the restaurant owners who struggle the most at tax time are rarely the ones who did anything wrong intentionally. They were busy running their business, and tax prep got pushed to the back burner. So let's talk about what that costs you. The IRS charges penalties for every month your return is late, and it can add up to 25% of what you owe. On top of that, there is a separate penalty for late payment, and that one adds up every month too. These two penalties can stack, and they start accruing the day after the deadline passes. A lot of restaurant owners assume filing an extension buys them more time to pay. It does not. An extension gives you more time to file the paperwork, but the IRS still expects payment by April 15th. Waiting to make a payment means interest starts building and a late filing penalty gets added on top of that. To put a number on it, let's say you owe $8,000 and you file 3 months late without paying. The late filing penalty alone could add over $1,000 to your bill. And interest keeps compounding the longer the balance sits unpaid. The IRS will send you a notice and work with you on a payment plan, but at that point, the balance is already growing. Getting ahead of it is now a lot less expensive managing it after the fact. But unprepared is a different problem from filing late, and in many experiences, it's more common for restaurant owners. When you sit down to file without organized records, a few things happen, and none of them work in your favor. Deductions get missed, meals served to employees on site during a shift, work uniforms, kitchen equipment purchases, repair costs, merchant processing fees, delivery platform commissions. These are all deductible expenses, and when you are rushing to meet a deadline, they slip through the cracks. A missed deduction is money you overpaid to the IRS, and you're not getting it back after the return is filed. Numbers get estimated instead of verified. Estimated figures on a tax return are a liability. The IRS matches what you report against third-party data, payment processors, bank records, and 1099s. When the numbers do not line up, returns get flagged for review. A discrepancy does not automatically mean an audit, but it does mean extra scrutiny and potentially a letter asking you to explain yourself, which takes time and energy you do not have during a busy season. And for restaurant owners, specifically, tip income, reporting, and payroll records have to be accurate. The IRS pays close attention to industries where cash transactions are common, and restaurants are at the top of that list. Discrepancies between reported sales, payroll records, and tip allocations are a known audit trigger. Getting those numbers right before you file is far less painful than addressing them after. Restaurant owners who operate as sole proprietors, LLCs, or S corporations are generally required to pay estimated taxes quarterly throughout the year. April 15th is not only the filing deadline, it is also a payment checkpoint, and a lot of owners find out too late that their quarterly payments were not enough. When those payments were underpaid or skipped entirely, The balance due on October the 15th can be higher than expected. An underpayment penalty gets added on top of it, and the surprise of a large tax bill with weeks to go can put a real strain on a business that operates on tight margins. Knowing your estimated tax liability before the deadline gives you time to plan for that payment instead of reacting to it. A CPA can run through those numbers with you and tell you exactly where you stand, so April 15th doesn't catch you off guard. Restaurant owners deal with a specific records challenge. Sales come in through multiple channels, cash card, third-party delivery apps, and each one generates its own data. Payrolls involves tips, employees, which adds another layer of documentation. Equipment gets purchased and replaced regularly. Food costs fluctuate. And in the middle of running a kitchen and managing staff, keeping all of that organized is generally difficult. The owners who walk into tax season in good shape are the ones who have a system running throughout the year. Even a simple one. Separate business and personal bank accounts, a basic expense tracking method, and quarterly check-ins with a CPA go a long way. For the owners who don't have a system in place, the work right now is getting everything together as completely as possible before the deadline. Incomplete is better than nothing, and a CPA can fill in the gaps. With a few weeks left, there is still time to get organized and file correctly. Pull your bank statements, your payroll records, your equipment purchases, and any 1099s you received. Gather your expense receipts and start categorizing them by type. Food costs separate from labor, utilities separate from equipment. The goal is walking into your CPA appointment with everything in one place so nothing gets left on the table and nothing gets estimated when it does not have to be. Do not wait until the week of April 15th. The window to get this right is closing, and filing a return that is complete and accurate is always worth more than filing one in a hurry. April 15th is close, and I want to help you get ahead of it. In a free 30-minute session, we'll review your income and expenses, identify deductions you may be missing, and put together a document checklist with clear next steps. We can meet in my Montgomery office, come to your location, or connect by Zoom. Book your time on the calendar now.